Hey everyone, and a huge welcome to all the CMA Intermediate students tuning in. Look, if you're deep in the trenches of exam prep right now, feeling a little overwhelmed by the absolute mountain of auditing concepts, take a breath. You are in exactly the right place. Today, we're going to strip away all the fluff. I promise you a foolproof, crystal clear breakdown of audit classifications, specifically tailored for your syllabus. We're focusing purely on how audits are classified based on their timing, setting you up to absolutely crush this section of the exam. Let's get right into it.
Okay, let's look at the game plan for this explainer. First, we'll hit periodicity-wise audit classifications. Second, decoding the continuous audit. Third, its advantages and demerits. Fourth, continuous versus period audit. And finally, understanding the limited review. Starting right off with Section 1, periodicity-wise audit classifications.
So, this brings us to a massive, and I mean massive, practical challenge in modern corporate auditing. The whole foundational concept of periodicity-wise audits essentially asks, when and how often does the auditor actually show up? So think about it. How do auditors review 100% of a giant company's transactions without bringing their daily business operations to a complete grinding halt? In the old days, with millions of transactions, checking every single thing was, well, basically impossible. But the answer to this problem? That is the absolute core of our explainer today.
Which perfectly tees up Section 2, decoding continuous audit.
This right here is the modern auditor's ultimate answer to high-volume, high-risk corporate environments. According to the Institute of Internal Auditors in the U.S., continuous auditing is a method used to perform control and risk assessments automatically on a more frequent basis. Now, what's genuinely fascinating about this definition is the phrase testing 100% of transactions. Technology is the absolute key enabler here. It literally changes the entire audit paradigm. We're shifting away from those old periodic reviews of a tiny random sample and moving toward the ongoing, continuous testing of literally every single transaction. It's wild when you think about it.
For exam day, you absolutely need to be able to rattle off the basic features of a continuous audit. Let's run through these super quick. First, it's conducted continuously throughout the year, not just crammed in at year-end. Second, the intervals can be regular or irregular. Third, and we just hammered this point home, it focuses on testing 100% of transactions. Fourth, technology is completely crucial to actually pull this off. Fifth, it gives management advance notice about errors and irregularities. And finally, circle this keyword in your notes. It involves surprise visits by the auditor. Make sure you lock these bullet points into your memory.
So, a great question to ask is, when does a company actually need this intense level of auditing? Well, a continuous audit becomes a downright necessity under three specific conditions. Number one, when the company's internal controls are totally inadequate, meaning the risk of error or fraud is sky high. Number two, when transactions run in just massive numbers, making a year-end sample totally useless. And number three, when management specifically requires periodic audited statements throughout the year just to manage their resources better.
All right, let's pivot to Section 3, advantages and demerits.
Now, it's time to put on our critical thinking hats and objectively weigh the pros and cons. The advantages here are incredibly strong, especially when we talk about speed. You get the early location of errors and frauds, meaning you catch them immediately, not 6 months later at year-end when the trail is completely cold. Because of this early detection, quick rectification is totally possible, and the client gets continuous guidance. It also ensures timely finalization of accounts right at the end of the accounting period. But beyond just speed, there are major behavioral benefits. It acts as a strict moral check, keeping the client's employees on their toes and efficient. Plus, it frees up the statutory auditors from all that routine testing so they can focus their efforts on way more valuable activities.
But, it's not perfect. Let's look at the flip side, the demerits. Honestly, the biggest risk is the alteration of records. Figures that have already been checked by the auditor might be maliciously altered after the audit is supposedly over for that period. That's a huge danger. Next, the frequent visits by the auditor, they can genuinely cause a lot of inconvenience at work. This often leads to a clash of duties, or just a clash of work, between the client staff and the audit team. Also, no surprise here, it is significantly more expensive because the auditor has to devote way more time. And for the audit staff themselves, the work can honestly become incredibly mechanical and repetitive.
Okay, for your exam prep, a truly great way to show deep understanding is to contrast a system's biggest benefit directly against its biggest vulnerability. The massive advantage of early detection, catching that fraud on day one, is immediately threatened by the demerit of record alteration, where someone sneaks back in on day two and maliciously changes the data the auditor just signed off on. Truly understanding this friction is the absolute key to mastering this topic.
Moving right along to Section 4, Continuous versus Periodical Audit. This is exactly how you want to structure a comparison question on your exam. Think about timing. Continuous happens all year, while periodical, which is also known as a final audit, is only done after final accounts are closed. Because of that relentless schedule, continuous is way more expensive, but that cost buys you detailed, 100% checking and early error detection. Periodical audits, on the other hand, rely on late-stage sample testing, so detailed checking just isn't possible and detection happens late. Ultimately, the continuous approach fits large organizations, while the periodical method is much better suited for smaller ones. Seriously, memorize these 5 critical distinctions.
And finally, we arrive at Section 5, Understanding Limited Review.
So, we've talked about continuous, year-long audits and traditional year-end audits. Now let's look at a very specialized, time-crunched exception. The whole concept of a limited review is driven heavily by regulatory deadlines. Take a look at Clause 33 of the SEBI Listing Obligations and Disclosure Requirements Regulations of 2015. It essentially states that a company must submit its quarterly and year-to-date financial results to the stock exchange within just 45 days from the end of each quarter. Think about that for a second. 45 days is an incredibly tight window. The auditor has very little time to conduct a thorough examination of the books, and honestly, the client usually struggles to balance the books and provide all the documentary evidence in that kind of rush anyway.
And because of this intense time crunch, the auditor literally cannot conduct a full-fledged audit. Instead, they have to make a restricted study of the books. Now, here is the absolute most vital takeaway for your exam. In a limited review, the scope is substantially narrower, and generally accepted auditing standards are not followed. I repeat, they are not followed. It's a completely different beast from a full audit, which is a thorough, deep dive examination that strictly adheres to all of those generally accepted standards.
So there you have it. We've completely broken down how the timing of an audit changes its entire methodology, from the relentless high-tech pace of a continuous audit to the traditional year-end periodical audit, all the way down to the regulatory sprint of a limited review. But as we wrap up, I want to leave you with a provocative thought to ponder, something to think about beyond just acing your CMA exam. As technology continues to evolve at breakneck speed, eventually automating 100% of transaction testing in real time, will periodical audits even survive the next decade? Or is the continuous audit destined to become the singular, totally unavoidable standard for every single business on Earth?
Today, we're going to build a rock-solid mental map of how audits are categorized. We'll be breaking down all this theory into clear, digestible, and highly testable concepts. Let's get that exam confidence all the way up.
Okay, let's dive into this. Here is our framework to focus for today. First, scope-wise basics. Then, complete versus partial audits. We'll hit detailed audits, cost audits, management audits, and wrap it all up with an exam summary. Section 1. Scope-wise classification. The boundaries of audit.
So when you hear that word scope on your exam, I want you to immediately think about boundaries. Like before we even get into the technical definitions, just ask yourself this really fundamental question: how much of the business should we actually check? Are we talking about looking at every single receipt or just a few specific areas? Well, the answer to that completely dictates the scope of the audit. And for your exam, that breaks down into 3 distinct categories.
Right, so the first category is the complete audit. And honestly, it's exactly what it sounds like. The scope here is not confined to any specific limits set by management or any other authority. The auditor literally has to check all possible aspects of a business. We're talking manufacturing operations, data flow processes, accounting records, the full shebang. But, and this is a big but for your exams, keep in mind that in general business practice, pulling off a truly complete audit, it's rarely feasible. It just takes way too much time and resources.
So, if a complete audit checks absolutely everything, what's the alternative? Well, that brings us to the partial audit. For the exam, I really want you to heavily contrast these 2 boundaries in your mind. A partial audit is a non-statutory audit where the scope is strictly restricted to checking certain specific aspects only. The auditor's powers of inquiry are limited entirely by their terms of engagement. They definitely can't just go digging wherever they want. Their boundaries are firmly drawn.
Now, what's really interesting about this is how super specific those terms of engagement can actually be. A classic example you'll probably see is an auditor being appointed solely to check the accuracy of transactions relating to just cash sales. Or even more specific, they might be hired to conduct an audit only for the month of Diwali. So just anchor that in your mind: partial means restricted.
Okay, the third scope-wise category is the detailed audit, which is also known as an audit in depth. Now, instead of checking a really wide boundary, this one goes deep into specific items. It's like tracking a transaction from its absolute beginning, the exact moment it's first entered into the books. The auditor meticulously examines every single stage it goes through in the accounting process, using various audit evidences, all the way to evaluating its final ultimate impact on the financial statements. It's basically a complete stage-by-stage life cycle check.
Section 2. Subject matter-wise classification beyond financials.
Let's do a hard shift here. We're moving your brain away from scope and looking at specialized subjects. First up is the cost audit. This involves a really dedicated examination of cost books, cost accounts, cost statements, and subsidiary and prime documents. Why? Well, to satisfy the auditor that these records represent a true and fair view of the cost of production. Oh, and this is important. It also includes examining the appropriateness of the cost accounting system itself.
And this brilliantly illustrates exactly whose domain we're stepping into. The Institute of Cost Accountants of India, the ICAI, is the ultimate guiding authority here. When you see this crest, it's your cue that you need to be precise with your terminology. They have a very official, mandated definition for cost audit, and examiners are absolutely going to be looking for you to recognize it.
So, here is that official definition, straight from the ICAI. A cost audit is a system of audit introduced by the Government of India for the review, examination, and appraisal of the cost accounting records and attendant information required to be maintained by specified industries. Definitely lock that phrasing into your memory, especially those key words: review, examination, and appraisal.
But you know, why do companies actually bother going through with this? Simply put, a cost audit acts as a really powerful tool of control in the hands of management. By analyzing all that cost data, it helps leadership clearly identify areas of operational inefficiency, and it pinpoints exact areas of wastage. It also renders invaluable services to connected parties. Basically, it's all about controlling operations so you can stop wasting money.
Section 3. Subject matter-wise, management audit. If the cost audit was all about checking the math behind production, the management audit is totally about checking the people running the show. Think about it. A company can have flawless accounting records, but if the leadership is making terrible strategic choices, the business is going to fail. That is exactly why we look beyond the finances to the managers themselves. A management audit is basically a company checking if its leaders are actually discharging their managerial functions effectively. Because this is a comprehensive and critical review of the entire management process. It covers all those core functions you learn about in business strategy. The audit will meticulously evaluate planning, organizing, coordination, and control. It genuinely assists managers at all levels by figuring out where things are going wrong and helping them effectively discharge those functions.
So, the crucial point is this. While a traditional financial audit looks backward at historical numbers to see if they were accurate, a management audit is completely forward-looking. It is an independent and systematic evaluation designed specifically to improve future organizational profitability and attain other predefined objectives. It acts as a guide to actually improve the efficiency of the management going forward.
Section 4. Final exam takeaways.
Hey, massive congratulations on making it through the core material. You've just processed a ton of crucial technical information. Now, let's move to and see how this builds your perfect cheat sheet for the exam. If you see not confined and rarely feasible, you know for sure it's a scope-wise complete audit. If the prompt mentions being restricted, like to a Diwali month, that's a partial audit. Audit in depth or recording to final effect triggers detailed audit. Moving over to subject matter, checking for a true and fair view of production cost is always a cost audit. And a forward-looking evaluation of managers, that's your instant trigger for a management audit. Memorize these associations.
Before we wrap up, I want to leave you with a quick thought exercise. Imagine a manufacturing company suddenly faced a massive, unexplained drop in profitability. Which specific audit classification would you recommend to uncover the root cause, and why? Would you check the costs, the managers, or do a detailed dive into specific transactions? Think about how you'd apply today's framework to that real-world scenario.
Today, we're zooming in on the subject matter-wise classification of audit. We're going to look way beyond the traditional financial audit and explore how auditing has evolved to tackle some really specific, dynamic business issues. This study session is tailor-made to give you the exact definitions, objectives, and legal context you're going to need to totally ace your exam.
So, here is our agenda. We've got 4 main areas to conquer today:
operational audit, tax audit, social audit, and finally, proprietary audit. Let's get to it. Starting off with Section 1, Operational Audit, where it is all about maximizing efficiency and economy. When you're sitting in that exam room, I want you to remember two specific keywords for this one: efficiency and economy. Basically, an operational audit involves a really deep dive into the control structure of the entire entity. It provides a critical appraisal to see if a department is actually operating in conformity with the standards and procedures laid out by management. For example, it's going to check whether capacity utilization in the production department or short-term targets in the marketing department are being performed economically to hit the company's predefined goals.
Now, I know what you're probably thinking. How is this any different from a standard internal audit? It's a super common point of confusion. Well, while internal audit traditionally zeroes in strictly on accounting operations, operational auditing goes way, way beyond that. It adopts a much wider scope. We're talking about looking at all the other operational areas, like production, marketing, and administration. It's essentially a massive, future-oriented evaluation of how well the organization's operating procedures are actually functioning in the real world.
Think of operational auditing as a vital bridge for top-level management. When a company is sprawling and geographically vast, management simply cannot control the day-to-day operations directly. There are just too many layers of delegated responsibility, right? So they rely on tools like routine performance reports, surprise checks, and periodic inspections. The operational audit steps in as one of the most powerful management tools to control operations right at the first stage, effectively filling up any information gaps left by those routine reports. It gives them the objective, first-hand information they desperately need.
All right, moving right along to our second category, and trust me, this one is heavily tested. Tax audit, ensuring statutory compliance.
So, what's the bottom line here? The prime objective of a tax audit is, quite simply, to stop tax evasion dead in its tracks. It is a strict examination of financial records, specifically to assess if the calculation of taxable profit is correct. But it doesn't stop there. It also ensures absolute compliance with the provisions of the Income Tax Act and verifies that all the conditions for claiming specific tax deductions have actually been fulfilled.
Okay, do whatever you have to do to lock this into your brain. Section 44AB. Section 44AB of the Income Tax Act, 1961, contains the vital provisions relating to the class of taxpayers who are required to get their accounts audited. And remember, this specific audit aims to ascertain compliance with the income tax law, and it must be conducted by a chartered accountant.
You might be asking yourself, if we already did a financial audit, why bother with a separate tax audit? Well, it's because the taxable income of a business largely differs from its base accounting profit. A financial audit looks at that accounting profit, sure, but a tax audit must carefully navigate through various statutory allowances, disallowances, deductions, and exemptions suggested under tax laws to arrive at the true taxable profit. It's a completely different lens applied to the exact same financial records.
Let's shift gears to something a bit more outward-facing for Section 3, social audit, measuring societal impact.
Take a look at this quote by Keith Davis. It totally sets the stage here. It reminds us that a business is fundamentally a social institution that evolves out of its social environment. In the course of earning a profit, a business takes massive resources from society, so it naturally follows that, in return, they should discharge certain duties to society for their own long-term sustainability.
Definitely keep this core definition handy. A social audit is all about how we measure the actual contribution an enterprise makes towards social welfare. It's a system of independently evaluating an organization's operations and critically appraising its real impact on society. It essentially measures and examines exactly how far the business has been able to discharge its social responsibilities.
Now, here is the absolute most important takeaway for your test on this topic. Right now, a social audit is a voluntary exercise. It is not mandatory in most countries, and that includes India. While we hear a lot about corporate social responsibility these days, the formal practice of a comprehensive social audit is mostly undertaken voluntarily by forward-thinking business houses that really want to prove their overall impact on society.
And that brings us to our fourth and final classification, propriety audit, focused on upholding standards and discipline.
This one is actually really interesting. It's all about evaluating whether management decisions have been undertaken in tune with accepted rules, standards, established policy, and delegated power. It goes way beyond just checking if a transaction was recorded correctly on the books. It asks if the transaction was the right decision to make in the very first place, based on public interest and financial discipline. You absolutely need to memorize these 3 evaluation pillars: public interest, financial discipline, and behavioral standards. The main objective here is to ensure the safeguard of assets, aggressively check for any misappropriation of funds, prevent the misutilization of delegated authority, and ultimately increase management productivity. Now, a crucial note for your exams: proprietary audit is not separately practiced as a distinct standalone audit in India. Instead, sufficient provisions requiring these proprietary checks are cleverly baked right into the Companies Act, KARUR, and other legislations within the context of a conventional statutory audit.
Okay, do yourselves a favor and literally take a screenshot of this master summary right now. It perfectly organizes the key differentiators you're going to be tested on. You can clearly see how operational audit looks inward at efficiency, tax audit looks at strict statutory income compliance, social audit looks outward at community welfare, and propriety audit looks at the fundamental appropriateness of management decisions. Truly understanding these distinct differences is the exact key to mastering this section of the syllabus.
Before we wrap up this explainer, I'm going to leave you with a quick mock exam scenario to test your recall. Can you confidently identify the right audit to apply here? Think back to the keywords we discussed regarding efficiency, economy, and checking cross-departmental standards. Got it? Awesome. Keep reviewing these core classifications, and you will be in absolutely great shape for your CMA exams. Thanks for hanging out, and happy studying!